Everybody, hello traders, investors. We have guests that has elite macro views. I've known Julian Brigden for probably a handful of years, and Julian at times even wants to know what I'm thinking, and I hope not lately, except for the semiconductors. But it's great to have him with us today because he's been right since the worm turned in the metals. In fact, he's been talking about if you could just put on a pair trade and be long metals and short tech, really came to the forefront in the last few weeks with tech taking a beating. So, welcome to hanging out with me for half an hour, Julian.
My pleasure, Dale. Thank you very much indeed for having me on the show.
Okay. People are always interested that get into the business. They have their own journey. God bless the broken road that led us to where we are now. It's not an easy journey, but I'm curious, Julian, what was your first gig in the industry and what drew you to the financial markets?
So, what drew me to financial markets? Long story short, I was in the pub at 17 because we didn't have IDs in the UK, and I looked out the window. I was going to go into the army actually, go to Sandhurst and go in the British Army as an officer, and I looked out the window and there was a kid who left school at 16 and he was in a 3 Series BMW. And I was like, what the hell is that? And it turned out the guy worked on the life floor in London and there was a floor broker. And I thought, God, if he can get a 3 Series BMW, then I can get a 5 Series BMW. Why the hell am I going into the army? And, I loved economics and I loved history. And that just seemed to be a logical sort of thing. And then through various sort of iterations, I ended up working for the company that bought Salomon Brothers, a company called
Oh,
Fibro.
oh
And
yeah.
they were a bullion shop. So I cut my teeth trading silver and silver
Okay.
options. And then I went to work for Credit Suisse in Zurich, which became, merged with UBS a few years ago, trading precious metal silver options. Then I went to Drexel Burnham,
Okay.
another investment bank. So you can sort of
Yeah.
begin to see the pattern here. And then got into FX, went to HSBC, then went to Lehman Brothers, and then went to Credit Agricole, and then set up my own business 15 years ago, writing basically macro research. And the whole idea, Dale, was to, we'd been quite successful. I've been putting out a sort of market commentary to clients as a way of cajoling clients to trade with me when I was sitting at the banks. And we'd been pretty good. We caught the global financial crisis. We made a lot of money for people. And one of my clients said, literally, what are you doing working for that shitty French bank? I can't do enough business to pay you for your information. Here's a check.
Okay.
Go and set your
Yeah.
own business up. So that
You
was
had
that.
you had an angel.
I had an angel. Yeah.
Yeah, the
Very many
only
thanks to him. I can't mention who it is because I'm not
yeah.
allowed to contractually, but yeah, they're still a client.
Oh, and let me say that the firms that you work for, like Fibro, became like one of the biggest commodity houses
Yeah.
on the street. They had muscle, people on the
They
floor.
had
If I,
real muscle in those
yeah,
days. Yeah.
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 Did you ever spend any time on the life floor? Or did you just skip that?
No, I didn't. I used to trade onto Comex. I used to do the IMMR, as they used to
Okay.
call it, for a while. And so I did spend, a couple of weeks on the floor in Chicago, but I never actually traded into any of I never sat on a floor permanently.
Okay. All right. Well, what a journey. And all the firms you were with, they were powerhouses.
They
So,
were, mate. Yeah, they were all a little bit the scrappy wannabes, I would say. But that just, to my mind, that just made me work harder.
okay. So, I want to talk about here we are, Julian. Everyone's sitting on pins and needles waiting for NVIDIA's earnings today after the close. Semiconductors have been under a lot of pressure. We're getting a rebound in the market today. Where do you sit with this recent pullback in the market? Does it feel to you like this is just the beginning, or are the bulls going to be able to come back in and take charge again from the levels that we're at today? Personally, I think the market needs a 10-15% correction.
Yeah, that's sort of where my head is, Dale, as well, to be brutally honest. I think it would be healthy. One of my friends, a guy called Kevin O'Dowd, and I sort of use Kevin quite a lot. He uses DeMark signals, and he's
Okay.
basically saying that if we get an update today, that's the confirmation actually of the downtrend. And you know,
Interesting.
I I look at this and I just sort of say there is there is there are a couple of fundamental problems that we face, Dale. Firstly, I want to state that I'm very concerned about the sort of structural setup of the US. I think this is and I've written this to my clients, a number of months ago, that I think the US is all in on the AI trade. And I don't just mean the equity market, I mean the whole economy. I think employment is dependent on it. I think wealth is dependent on it, and wealth has never been more important in the US to drive this whole train. So I think if this thing goes belly up, we are going to a bad place as a country, right? And I live
Okay.
here.
Okay.
I
And
think things could get very, very ugly. Now, the question is are they going to go to a bad place? And so far so good. This is a correction, arguably within a trend. But I think there are some fundamental questions being asked, not so much about the broad AI trade, Dale, but about one company, OpenAI.
Sam, okay.
OpenAI.
Yeah, you're right
And
about that. Why are they coming? They're like a big bank. They're
because I
coming to the
think,
U.S. government for a backstop
yeah,
already.
I think when you start to look at AI traffic, um, their revenue and accounting um, for CapEx, I think you can argue that there's a rat here, right? And on the day that the OpenAI CEO came out and mentioned that thing about the government guarantee, I wrote an X comment where I said I smell a rat.
Yeah.
And to me, I've never believed, Dale, that there was any money to be made in large language models. I think these things are far too easily replicated. They can train themselves off each other. And essentially, if someone comes in with a breakthrough a few weeks later, they've all can do the same thing. And so when he started throwing around, numbers of capex in the trillions, I just basically called bull. I just do not believe he's ever, ever, ever going to be able to deliver. I think you can see from that podcast he did where he got incredibly defensive and aggressive that this is a guy under enormous pressure to try and get the financing, get the numbers. And so it's not that I don't think Google's going to spend on it, Amazon's going to spend on it, but arguably OpenAI should just be part of Microsoft, right? And the question is what price do Microsoft pay for them? I think when the company fails, I've got a number of clients who thinks this is a zero as a company, arguably.
Wow.
And then let's say that Microsoft decide they're only going to spend 300 billion of the 1.3 trillion, right? What
Yeah.
does that do to the whole space, Dale?
Yeah.
Right? That's my concern. It's not, is the technology transformative? I think you can make arguments on both sides. I think, don't worry, I think we will learn to use it highly effectively. But I just don't think there's anywhere close to the ROI that many people are assuming. I mean, I've always believed that the investment of the likes of Google or Meta was essentially faced with an existential threat that could destroy their existing legacy businesses, right? Because there's no question that AI could destroy the advertising space, right? Which is what Google's in, and the search space, or the social media space that Meta's in, that they just decided they have to invest. And I think that's when you hear these guys saying, we had no choice, we'd rather overinvest. But I think the markets looked at this and said, oh, well, you know, not only is Meta going to be the king of social media, right? But they're going to spend all this money on AI, so they must be able to like find a cure for cancer. In other words, there's just going to be this completely new revenue stream that's going to come in. And to me, I just think what it may do is shore up their existing revenue streams, not really generate new cash. And so, you know, we're also turning these companies from cash cows into capex cows, right? Capex cows generally don't trade as well. You know, so it just looks to me, Dale, that you know, I'm not saying this is the big correction,
yeah,
but I'm sort of with you that I think a 10 to 15% correction would be good now. And then after that, I'm going to, you know, are we going to new highs? I don't know, right? I mean, we could rally substantially from that point, but new highs again without new liquidity. And I know, you know, some people are talking about that the Fed's going to have to come in and do stuff. I mean, one of the reasons I've been bearish recently is I don't believe the Fed wants to do that at all. I think if the Fed had their own choice left to their own devices, you'd be one and done. You'd be December and then screw you, we're done. We're going to wait to see inflation come down. We're not cutting anymore.
Okay. I wanted to ask you if part of the cynical outlook is this circular type of investment between these companies where I'll invest in you and then I'll invest back in you and then I own part of this and then I'll buy that from you.
Well, look, I would never want to accuse anyone of securities fraud, but there is a securities fraud called round tripping, right? Where let's say there were three of us, Dale, right? I get $100. I give you the $100. You give the $100 onto another counterparty, and the counterparty gives it back to us. And in the process, because we're all trade on a 20 PE, right? All of our companies are worth $2,000. It literally, that is securities fraud. And, you know, while I'd never want to accuse anyone of that, you know, some people have argued that that looks quite similar.
Yeah. And also, you talk about Sam Altman being defensive. What about Palantir's CEO when he came on and
I mean,
after he heard about Michael Burry's position shorting Palantir in the video?
Look, I mean, these guys are. Look, I think one of the things we've gone back and we've looked at what we call classic bubbles. So classic bubbles are, you know, Japan in the 80s, the Dow in 1929, the NASDAQ in 2000. And they, you know, for someone like you, they have a very, very, very defined price action, Dale, right? A very, very defined price action. And if I can, I'll show you a chart.
Okay,
if I can share.
Okay, I stop sharing and then
all right, and I will show you what I think is one of the perfect classic bubbles, and that was silver on its last major run up to $50. Not this time, but the time before. And we'll just use it by way of illustration. Hold on one sec. I'm just going to share. Okay. So let's
got it.
Okay. So this is a classic bubble pattern. So you have a stealth phase, so it's like very, very early adopters, Dale, right?
Right.
You then have a discovery phase where the institutional money typically starts to enter. Typically, the price at least doubles during this period, and you can see this sort of run up here. You then have that institutional money going, cool, made a lot of money in that one, right? Yours. Yeah. And then the market sells off, and we typically have a bear trap. Okay, we come back to this sort of longer term line. And this is where the retail money or, the fast money starts to come into it, right? And this is the beginning of the mania phase. And in the mania phase, we get these bouts of consolidation, breakouts, pauses, breakouts. But it always ends with this blow-off parabolic kind of move, okay?
Yeah.
We then have a sharp sell-off, right?
Yeah.
And a failed bounce, right?
Yeah.
And that's the bull trap. And once the bull trap is sprung, Dale, that's when you begin to think about shorting this, because it's very hard in this move here. You're never going to catch it up. Occasionally, if you use things like DeMark signals because they give their 13s, you can conceptually nail the top, but it's really very, very hard. Then you start the long-term bust. And in the case of Japan, in the 80s, it took a decade to get back down to this long-term trend line, right?
Yeah.
Now, silver did it quicker. If you look at something like Lionsgate, the film company, it did it in a matter of months. We had Triple D, which is a 3D printing company that became a phenomenon, I think, back in 2012, 14, I can't remember. That shot up, did the same thing. But this is basically what you're kind of looking for. And I look at lots of stocks, particularly some of these stocks in the private equity space, right? KKR, Apollo, Ares, and they all look like this. Jefferies, they all look like this.
They're all in the parabolic stage.
No, they've all actually arguably already had the bull trap rally and failed.
Oh, okay.
So now you're looking for you're in the bust, arguably, and this stuff is going to come down. So, do we bounce here? Do we get these patterns in? Because if private credit goes or private equity goes, we've got a big problem in this country because it is so pervasive.
Well, UBS closed their credit division.
Right.
So, and Jamie Dimon's talking about cockroaches, and
I think, look, I'll be honest with you. I think Jamie's got an element of, I think he'd love it if someone like Apollo or someone was in trouble, because then he could swoop in and buy it for cents on the dollar. And these guys, what's happened is that these guys have disintermediated the banks because of the regulatory capital requirements that were placed on the banks post the global financial crisis. And so, now he's looking at, deregulation next year, which will free up his balance sheet. And now he's like, wait a second, you've taken my back garden. So, let me kick you a bit and get you down so that maybe, some assets fall out that I can pick up cheap. So I'm a little cynical, but he's right? This is where the opacity is. This is where we don't know what's going on. And the easiest way for me to look at it is to kind of move into your world, Dale, and look at the charts.
Right.
Because the price doesn't really lie that often. It's king.
It's the king. And, I wanted to ask you about, when you're looking at this parabolic stage, and then we get the failing rally, do you look at the fact that commercial banks, although they're regulated, that they are behind the funding of the shadow banking system? I mean, it's not like they're there's a firewall between the two of them. Because they were the financiers of the shadow banking system, they're vulnerable, and I've seen some cracks in the financials.
There's also the insurance companies. That's the other problem as well. I mean, there's a couple of great articles in Bloomberg over the last couple of days about the sort of incestuous relationship between insurance companies, arguably your insurance company or life insurance company or whatever, and private equity. I mean, the tentacles of this business are absolutely widespread, but you're absolutely right. There's this assumption this stuff will not blow back, into the banks, and I think that's just wrong, right? I mean, you can look at within the Fed data, they release what banks are lending to commercial companies, right? And if you look at that relative to their total loan book, that has steadily fallen, Dale, since like 2016, right?
Okay.
The mirror image is what they have lent to what they call non-bank financial institutions, which are a lot of these private
Yeah.
equity, private credit firms. And it's literally, as one has gone down, the other one has gone up. So essentially what banks have done is they're lending to the middleman now,
Right.
the Apollo, the Blue Owl, the
Right.
KKRs, these guys, and not directly to the corporate sector. And that's really a function of the capital requirements that were put on them, because it's more expensive from a capital perspective. So in other words, less attractive to lend to some small and medium-sized company than it is to lend to KKR or Apollo. Right?
Interesting. Yeah. So it was a profit margin incentive for them to take on all this exposure.
Well, yeah,
So
to allow these guys to basically move into their space, and to allow these guys to disintermediate them. But to your point, it doesn't mean that the underlying exposure isn't there, right? So if we have an economic slowdown and we get problems in the private credit space, because remember, the way this thing works is relatively simple. Private credit, private equity, you walk into a firm, you typically, and this thing is pervasive. It could be the dentist's office, right? We've all heard, I think I got scammed by my dentist, right? He pushed me into doing some procedure, and then my insurance company refused to pay for it, right?
okay.
And
Yeah.
it was a more expensive procedure. But the way that you walk in is you kind of consolidate a bunch of these things, you remove the principal, that improves the cash flow. You then look at that, project that cash flow, max it out according to the debt that you want. You max out the debt according to that cash flow. And as long as that cash flow is modeled correctly, you're fine. The problem is inflation and tariffs have come along, and we know that they've hit different sectors of the economy differently. Just like we have a K-shaped consumer economy, Dale, we have a K-shaped corporate sector, and a lot of these businesses are beginning to get really, really stressed. So that's why these private equity and private credit firms are struggling to offload them. There haven't been the public offerings that they many wanted. They've been playing kind of pass the parcel between each other. Oh, I've got this deal, why don't you refinance it? It's a very incestuous kind of messy world. That's what worries me. It does in many respects resemble that ridiculous spiderweb chart we saw in the AI space, right, where they're all kind of cross-lending, throw some banks in there, the insurance companies. But look, if this were to go down, because we got a real economic slowdown, and I don't think that's a given, I think it's a significant risk, but I don't think that's a given. It would happen if you got a sustained drop in the equity market, and not much. But yeah, I mean, things could unravel quite unpleasantly.
Okay.
Right? And as I said, I'm just watching all of these charts. I'll just share like the classic bubble I said to you. I mean, here's Apollo.
Okay, and I also wanted to ask you, because it's important if we're going to enter that type of environment, do you think it's important that people know what a safe bank is for holding their assets? And
I mean, I think, look, I think the banking system in aggregate, just to say, here's the Apollo chart. I mean, it looks exactly like that silver chart, right?
It does.
Pretty much, right?
Yeah.
I think the banking system is incredibly safe. I don't think one has to be worried about that. I don't think you need to be worried about that at all.
No bail-ins.
No, I don't think so. I think we do need to be potentially worried about. I do think we need to be potentially worried about some insurance company exposure, right? And I think that could end up hurting a lot of Americans if indeed we have a problem in private credit and private equity. As I said, Bloomberg ran some fantastic stories on that.
Well, they hold a lot of pension funds for people.
Yeah.
Right? There could be, and the pension fund guarantee fund is really small.
Yeah.
So if there's pension problems, that's a big problem.
Correct.
Probably will be bailed out. So why don't we wrap it with just taking a quick trip around the markets? And I know that you're a metals bull, and we've had a little pause in it.
Mm.
But why don't we start with where you at on the dollar?
Yeah.
I thought we could go to 102. Um, and then I gave up on that idea, and it looks like it's about to happen. We're about to cross the 50-day moving average on the Dixie.
Yeah. I mean, the one thing that I would say is that when I look at FX, I think the problem with the dollar index is you've really got to start parsing some of this stuff.
Yeah, it's a euro.
And it's not really I think it's mostly dollar yen that's driving this baby, Dale. And they've got a problem, right?
Yeah.
They've got a very significant problem. You know, I wouldn't be at all surprised if we're beginning to get to levels which are making it very uncomfortable for the Japanese administration, particularly given what Scott Bessent said. So to all your customers, I'm not saying I would be selling dollar yen now at all,
I've been trying it.
but I think look, between 160 and 161.40, 161.40 is
Interesting.
a multi-decade line in the sand,
Here we are.
right?
Yeah.
Multi-decade line in the sand. You can take that back into the 80s, Dale, and you'll see. As we get towards 160, I'm beginning to expect
Intervention.
intervention. Yeah,
Okay.
yeah.
So there you are. Okay. Doesn't go back far enough. But okay, so we're going to test these highs up here. We were there. I think this was intervention up here too, Julian.
Yeah,
And I think
yeah,
the BOJ made it was successful. They made
yeah.
some money on this
And
one.
I think, look, what worries me a little bit, Dale, is the yen carry trade is back on again, right? So there's a
Yeah.
lot of people funding themselves on the basis of funding themselves in yen again. And when you look at, say, interest rate differentials, you could argue that the dollar yen should be a lot lower. So if you go back to remember mid 2024, when we had that big sell-off there, that was exactly a yen carry trade again, and then the BOJ
Right.
came in and flushed people out. So I think that's a risk again.
Okay.
Not right here, right now, but I think if this thing keeps pushing higher, which it looks like it wants to do, to your point, it looks like we're breaking out.
Yeah, well, it's a throw over at the minimum.
Yeah.
Yeah. Yeah. So okay, so we have that. This pullback in gold. Um,
I mean, I would, to be brutally honest, I would really like a little bit more. I'll be
yeah,
honest with you.
I agree.
I would like to say, look, I'm a massive silver fan. I think the thing's going to like $200 or $300 by the end of the day. I'm a little
Yeah.
concerned as to the macro environment that will get us to $200 to $300, Dale. But that's as a by the by.
Yeah.
But I do think I would like to see a move maybe into the low
40s.
Yeah, maybe even the upper 30s. And I
Okay.
think that can possibly come in a general risk-off environment because
Yes.
there's no question that these things are owned now, right? They are
Right.
part of people's portfolios. So when you get what the pros call a value at risk shock, a VAR risk, there's no question that this stuff is going to get everything gets sold off in that environment.
It is. I tell you, I learned a lot of things about the environment we're in today, Julian, from you.
Thank you,
And
Dale.
really, you put the way you put together the whole jigsaw puzzle is fascinating. And I know that people that are hearing you now, live or the interview later, are going to want to know how they could stay in touch with you and keep up with what you're thinking. And looks like you have different options for people
We
to.
do. The easiest thing is to reach out. I mean, there's a big team behind us, so I'm not going to claim everything, Dale. In a way, I'm just as we would say in the UK, the gob on legs, right? But there's a lot of people behind me. They do some great work, and we offer it both to the institutional client base and to
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 retail.
retail. Yep, to retail. And so the easiest thing to do is to go onto the website. Here you've got mi2partners.com, click and have a look. And then if you want, you can reach out to our guys at support@mi2partners.com. Support@mi2partners.com. And look, if you just want the free stuff, you can you can reach out to or follow me on X.
Oh, okay. Oh, I know Harry. He
Yeah,
interviewed me once.
yeah,
He looks like you have a strong team too, Julian.
yep, we do.
So this is going to be a very interesting 2026. Give me your biggest call for what you think is going to happen. Are we going to run into a debt wall of trying to refinance things from years ago that's going to be a problem in 2026?
I I think here's what I will say. I think it's very hard to make that specific call right here, right now. I do think we're
Okay.
going to see a weaker dollar, Dale. I think
Okay.
that's coming in the first half of the year. Uh, exactly what the trigger is, I'm not 100% sure. So
Well,
I
how about the new chairman of the Fed,
well,
who's
yes,
going to be really President Trump will
yeah,
be
and I keep
directing
hearing
monetary policy.
exactly, and I keep hearing that we're erring more towards the puppet end
Yeah.
of the sphere. Um, but yes, that's what I'm hearing.
Plus, they want a lower dollar.
They do. They do want a significantly lower dollar. So that's what I'm looking for because I think that just unlocks a whole myriad of different things, Dale.
Yeah. So commodity bull continue and maybe look for some of the out of favor stuff, like maybe 2026 could be a good year for oil
Yep,
and grains and overlooked commodities that have been out of favor for a while. Just like the
yep,
market rotates sectors, we could go to different sectors of the commodity complex.
yeah. I mean, look, my favorite PA trade is a pair trade, and I think this is a multi-year trade. Is XME against XLK. So it's the mining and
That's
metals
what
ETF short against the tech ETF. It's on a ratio, it's 0.3 at the moment. It's come up from 0.23. So it's been not a bad trade. That's a big, obviously, percentage return.
yeah.
I think it's going to 3. So I think it's an 8 to 10 bagger from here.
All right. That's leaving people with something to really chew on. And to me, this was speaking of chewing, it was a great meal. Financial, you gave us appetizers and main courses, and I think that if you don't listen to what Julian's saying, you might have some indigestion. So I encourage people at the minimum to follow you and to check it out and stay in touch with your macro view. And what I like, what you do, Julian, is you also blend your fundies with technicals,
Yeah.
and you're an excellent technician. Nice charts you showed today.
Thanks, mate. My pleasure.
So I'm a fan.
Perfect.
My
Thank you,
trading
Dale.
and my trading warrior brother, Julian Brigden. Check him out and talk to you down the line, Julian.
Cheers, Dale.
Have a great year end and